Ooh, big question today. Should you average down or should you hedge your bets? That's a big question that a lot of people ask. Should I average down? Is it better to average down? Is it better to hedge your bets? Do you have a system where you can hedge? Do you know what hedging is? Well, the answer to both those questions we'll get to. But what I found over time, and over all the years, and I've been trading for 30 years, is every time you average down, you'll either get out of your trade at a break even or you're going to lose more. 9 times out of 10, okay, I'll give you the benefit of the doubt, 8 times out of 10, you'll lose more. It'll go worse or it'll get worse. And you'll average down a second time and it'll get even worse and you end up taking a massive loss. There are those cases where it turns around, goes back in your favor. The minute it goes back into profit or it goes into break even, your psychology tells you to run like hell because it's been such a nasty trade. It's gone against you. My advice always on averaging down is don't do it. I would rather stop loss out. Let me let you in a little secret. I actually saw an account blow because of no stop loss. And at that, an investment account. There's a lot of controversy surrounding whether you should average down or take a stop loss. And the main controversy comes from the investors, the swing traders, the traders that are holding things for a longer period of time, or the investors that are holding things for a long period of time. But even if you're an investor, you should really consider having a backup plan. You should consider protecting the investment one way or another. I mean, a good example of an investor watching their trade go to zero was in South Africa. There was a company called Steinoff that went from nothing to 80 Rand. It was the darling of the stock market. It was the darling of all the purchases. It went to zero. It literally went to zero. It tried listing in Frankfurt. They discovered all the anomalies and it just crashed. I owned that, and I can tell you I was one of the fortunate ones that got out on the high because it went down so fast. It was incredibly ridiculous. And there were still people buying on the last day. Whether you're trading an index, whether you're trading a currency, whether you're trading a stock, really a commodity, it really doesn't matter. If you don't have a stop loss on that on a day trade, there's a good chance that you're going to lose. You've got to at least have a one-to-one, a backup on that. Take the small loss, then take the big loss. You hear what I'm getting at? We're looking at how much loss you're taking on these trades. Guys, trading is risky. 80% of traders lose money. In fact, in some cases, 99% of traders lose money. And if you don't like losing money and you don't like risk, rather don't trade. Probably better in the long run. While you're here, go and get your free trade every day at my secret blog. The link is in the description below. It's totally free. It's just a trading idea. It's not trading advice. It's just a trading idea. Please go and enjoy it. Also, while you're there, there's a free Forex book. Might be in the description. It is in the blog and it's in the index of the blog. It's on the side. It's a PDF. You'll find it there. It's for you. Go and enjoy it. But while we're on the subject of should you average down, let's talk about hedging. So one of the things that a lot of traders do is if they start going into a loss, let's say you took a long trade on a product and you started going into a loss, what a lot of traders will do if it's going down is they'll take a short, which is called hedging. So now if you had one contract going long and it went into a loss against you, you take one contract going short. Now that loss that you've taken just stays constant. It doesn't get worse. Now what you're doing is you're hedging, and now you're taking a short trade and it's going down, going down, going down. Trouble is, when do you get out of your hedge and when do you turn it around? Because now if it turns around immediately and goes long, then you're still going to follow that loss all the way. Even if you start going into profit on your long, then you've got to decide when to get out of your long. So it's just as you might as well just be trading under a normal circumstance. You might as well just be taking stop loss on your normal trade. The thing is, if your trade turns against you and you see a different trade emerging, you could hedge based on that. And then you've got a hedge going on a secondary trade, and when that trade plays out, you can get out of that hedge, take that profit, and hopefully it'll turn around and go back towards your long. You can either break even on your long or take a profit on your long. There is that type of hedging that you can do. Hedging is dangerous. You could blow your account with hedging if you don't get it right. The point with hedging is you don't have to take a stop loss. So people get quite excited about hedging because they think that hedging or hedging their bets on the same product will somehow stop them from losing. But effectively, it could make things a hell of a lot worse because that loss that you're taking, while it stays constant and you start making a profit going this way, once you get out of the trade, you're sitting with that huge loss that you need to make make back because you've only made the profit from that point to that point, and you've either got to make a decision to stay in the trade and carry on hedging forever, or you're going to get out of the trade at some time. What's the difference between that and understanding when to get out of your trade when you're not hedging?
Oh, God, Meg, that's sick. That's your mother.
I'm just trying to fit in.
Get out. Get out of this house. I said no. That's good about your modeling, Lois.
What's the difference? You've still got to make a call. You've still got to make a decision. The difference being, if your hedging works out for you, you're not going to lose any money at all, and you're not going to take any losses in the market. Your hedging's got to work out for you, and you've got to know when to get in and out of those trades. Some brokers offer both types of accounts. There's the account where you cannot hedge, where you can only take a long or a short on a product, and if you sell one and you've got a long, it's going to go to zero. So be careful of that. To have a hedging account, you've got to be able to buy one and have one. Have one long contract short and one long contract long at the same time on the same product. That's hedging. That's being able to hedge. And then you can decide which way the market's going and jump out of one of the bad trade or whatever the case and just take the money on the long trade. But as I say, what's the difference between that and just your normal daily trading and understanding when to get out and when to get in? I'd rather, on both those counts, averaging down and hedging, I'll actually rather stay away from both, and I'll rather just stick to stop loss, because if your trade invalidates and it's not working out anymore, just move on and just get on to the next trade and concentrate on that. Stop trying to save the trade that's gone against you and gone wrong. At the end of the day, the market's going to do its own thing. You can't control it. You can't control which way it's going to go. You can get yourself into such a mind if you get into hedging, because you're going to concentrate on that one trade. You're going to try so hard to save it. You're going to go all over it trying to save it, hedging this and hedging. You know, the funny thing about a market, I don't know if you've noticed it, you get into a trade and it turns against you, and in so many cases, and you think, oh, not again. It's almost like the market's watching you, but it's not like that. So now when you're hedging, so it's going against you, your trade's going against you, so you hedge and you think, well, I'm going to go the other way now and hedge this bet, and the minute you do that, it goes the other way, and it goes the way you were expecting it to in the first place. Now, what do you do about that hedge? Because now that's a loss. Now that's a problem for you. Rather just manage your risk, take your stop losses like you should, and just trade normally. Forget about all the BS and all the systems and all the strategies and all this. Just buy long, buy short, sell when it's necessary, become a good loser, become a great winner, and do it right. Don't play games, guys. You try these games, and let me tell you something, you're going to blow more accounts than you're not going to at the end of the day. To play those hedging games, you've got to be a top trader. You've also maybe got to have quite a large bank account to play those hedging games, because you're going to have to back it up one way or another. And when you take those losses, you don't want to be feeling the pain. I hope that gives you some insight into whether you should average down or hedge, because you know my feeling on it. Manage your risk and take your stop losses. Thanks for watching, guys. Watch the last video. Till next time, thanks and bye.